Hello, in this lecture we're going to talk about the decision as to whether we should close a department that is operating at a loss. We will be able to, at the end of this, analyze relevant costs related to the decision to close a department or segment that is operating at a loss. So the quick scenario is going to be this. We have our warehouse here. We've got two departments within the warehouse. Department 100 is having income of $44,350, and the second department, Department 200, has a loss of $16,950. Therefore, the total for the company is $27,400 of income. So we have income on the company, but obviously this Department 2 having a loss of $16,950 doesn't look good, and it seems like an obvious decision that we would just say, well, we should just eliminate that department and we would be having income of $44,350. But the decision's not quite that simple, and the reason is that when we allocate the costs to different departments, oftentimes we're allocating things like fixed costs that may not be eliminated if we eliminate the department. For example, if we eliminated this department, but we still had this entire warehouse, then if we were allocating part of the cost, which would be reasonable, to the maintenance of the warehouse and the depreciation of the warehouse, it's possible that obviously the depreciation would still be there at the least. And if we're talking about management salaries and these types of things on the central office, and we're allocating those costs to the departments as well, that would make sense for many types of decisions, but it would not make sense in terms of the decision to close the department. So we can't just look at this bottom line number and make the decision based on that. We got to dig a bit deeper into that in order to make a relevant decision for that. So let's do that at this point. So here's the information. Here's the bottom line that we just looked at. We got the $44,350 of Department 100, income, the loss of $16,950 for Department 200, and that gives us income of the $27,400 broken down in this way on the income statement. So we got the sales, the cost of goods sold, and the operating expenses here. And we're going to break these out. What we're really going to look at is we're going to go through these expenses from the cost of goods sold down to the advertising, the store depreciation, the store supplies, and the depreciation. And we're looking for those ones that will be either avoidable and which ones will be non-avoidable. Meaning, if we were to eliminate the Department 200, which costs would be eliminated with the elimination of Department 200, and which costs would not be eliminated with the elimination of Department 200, meaning they would still be there. They would just be reapplied to Department 100. And so we need to basically do that allocation and then see if the decision makes sense. So if we break these out, we're going to go through these costs. We're going to say, here's the cost for Department 200 for the cost of goods sold. Clearly, that would generally be eliminated. We can get rid of that in total cost if we got rid of the department. We wouldn't have the cost of goods sold related to Department 200. If we skip down here to the advertising, we're going to say that the advertising would be eliminated. We wouldn't have to eliminate advertising related to that department, so we're going to say that's going to be eliminated. We're going to say the store supplies are going to be something that we can eliminate entirely. And the depreciation, however, we're going to say that's not going to be eliminated. That's one of those things that, like if it was depreciation on that warehouse, we just applied that to Department 200 based on some type of ratio or something like that. If we eliminate the department, the depreciation doesn't go away. It just is going to be reallocated to Department 100 or some other location. And then we've got the sales salary. If we eliminate the department related to that department, we're going to say that that is something that we can avoid. We can eliminate it with the elimination of the department. We've got the rent expense. We're going to say that that is something that is not eliminatable. We can't eliminate that. It's unavoidable. So we're going to keep the rent expense. That's something that is allocated, not something that will be going away if the department goes away. Bad debt expense, another one that we're going to say doesn't go away. We're going to have bad debt expense still going to be there, even if we remove the department. Unavoidable. The office salaries, that's another one that we often, when we break out the departments, the office salaries are usually going to be allocated to the departments in some fashion. If we eliminate a department, the office salaries are still going to be there. And we have the insurance expense. We're going to say that part of that is avoidable. We're going to say we can reduce the policy if we get rid of that department, but part of it will not be avoidable. And therefore, we have to split that one out from the 8, 8, and 5 for the 13. And the miscellaneous, once again, we're going to say part of that is avoidable, and part of that will not be avoidable. And so if we add up these, we're going to say the avoidable then is going to be added up to the $266,500. Those are the relevant costs that we need to compare to the income for that department. The unrelevant costs in terms of this decision are going to be the $32,450 that we should not be considering when considering whether we should close department 200. So if we break that analysis down, we're going to say, okay, the sales then are going to be this 282,000, and the avoidable expenses are only the 266,500, and therefore the department is actually generating revenue. We're actually better off to have the department. So again, that might look confusing. You might be saying, well, it clearly says we have 16,950 of a loss here, and we have 15,550. We're saying that it's helping us generate. And once the reason for that is that we're allocating things to the department for good reasons, for analytical reasons, to see how the department's doing, see where we can improve. We allocate certain costs to the department based on that. That's how we're coming up with this 16,950 of a loss. But if we eliminate the department, not all costs will be eliminated with the elimination of the department. So that's why this analysis needs to be done in order to see whether or not the elimination of a department who looks like it's operating at a loss and is, on that perspective, it would really benefit the company, or whether it would not benefit the company. In this case, we're saying no, it wouldn't benefit the company. There's another one of those problems too, that if you see these in book problems, often the scenario is going to be in this format, right? It's going to say, yeah, it looks like we should eliminate it based on first glance. If you dig deeper, then it shouldn't be eliminated. So when you're working book problems, obviously that's probably going to be the scenario that works out a lot of the time.